Yo, what is up, dudes and dudettes? I had to say this. This is some other reasons we love Expensify so much. And too bad you cannot trade options. We tend not to hold on stocks that you cannot trade option at, but I just can't stress that how much I love Expensify, how much we love Expensify. And in this video, I'm going to share with you some fundamentals and financials behind why it is such a great investment opportunity and why we jump on the IPO right before it IPO'd, and then using the function on Robinhood, and I bought some shares that we think is totally worth it, and we're going to hold on to that share to our life for a long period of time. And we do see a huge growth in Expensify, and we see some pivots on Expensify. But on these growths and pivots is going to be on a second video. This video, I'm just going to analyze their S1s and tell you guys, hey, this is a really great investment. And right now, if you guys think the $3.8 billion market cap is overvalued, you're wrong. And here's why. Alright guys, first of all, you have to realize that Expensify is one of those rare unicorns where when they IPO, they actually are making revenue. And if you look at all their net income numbers over here, you will see that except for 2020, which is the year that nobody makes money except for trading firms and people who are doing hedging on commodity prices, people like JP Morgan, people like certain banks who are utilizing the flat yielding curve, and because the yielding curve are going a little bit unflattened, their potential revenue will go up and up and up until the end of taper. And then when the interest rate hike happens, and the entire equity market will go down, and then sort of like the bank earning and profitability will increase domestically, but in general it's gonna get flattened out. But anyways, right, we're talking about Expensify, and Expensify is only one of the only few, I'm pretty sure I can count with my fingers how many of those IPOs actually makes money. And Expensify is one of them, and it's one of them that actually makes the most money in terms of how much of revenue it's making. And if you look at, so first thing when you look at a financial statement, you want to look at how much revenue they are making, and you have to determine whether their revenue can grow or not. Right? So this is 6 months revenue. So at 12 months revenue, you will see the revenue will probably twice as that much, right? So 12 months revenue, it will probably, wait, is this ended in thousands? Yeah, in thousands. So the 65 million, right? It makes 65 million in 6 months. So basically, 12 months ending probably will make 130 million. Okay, and if you do the 10x multiplier, because A, Expensify is a cloud-based platform, it's very lean, and B, it's basically a financing, so it's a FinTech app, right? So we're applying a higher multiplier because we love this company. So the multiplier is around 6x to 10x of their regular revenue. We can do it sort of in a PE perspective. So if they're making $130 million per year on a 12-month basis, not adjusted for seasonality, that means this company at least worth $1.2 billion. That is no-brainer, okay? That is no-brainer. That is no-brainer to the no-brainer, okay? No-brainer. And as I predicted 4 years ago, this company will worth about $2 billion in no time, okay? So again, I'm just reinforcing that I'm not so good at this thing. But anyways, and then after you look at their revenue, look at their cost of revenue, right? In here, the cost of revenue, I think, included a lot of other things. Like I think included customer acquisition and their app costs and maintenance costs. And those numbers, you would expect this number will drastically go down around 2022 and 2023. Especially when after they get a bunch of IPO offering money from the public, and then they can utilize that money to lower their cost basis. And because they're now a publicly traded company, that means their stock is more liquid, more people know about them. And then third of all, you will see the effectiveness of amortization of their app, amortization of their cost structure, amortization of their previous cost include around from like 2008 until now, because they didn't break profit until I think 2018 or 2017. I'm not really sure. I gotta go back and look at the thing. So then all of their operational losses can be basically used to offset their tax, and then because they're piling up a lot of losses before, therefore the cost of revenue actually would increase the second and the third year after they break even, right? So we're talking about 2018 and 2019. So after 2019, their cost of revenue will actually drastically go down, which, well, technically 2020 doesn't count, but if you do the math, they actually, decrease a lot, right? And then on 2020, in 2021, if you time that by 2, because we're trying to do it like year ended, you will see that the cost basis is slowly decreasing as an increasing rate. So if you look at, and of course, if you look at the research and development, you will see that they're actually spending more and more money in research and development. This is really great. Why? Because technically speaking, they're still in a growth stage. So the more market it can capture, the more money they put in R&D, the more money, the more addressable market they can basically penetrate, the more potential revenue they will make. And in the next couple of minutes, I'm gonna basically tell you that they can make twice the amount of revenue they're making right now by the end of 2024. But this is just my speculation. And general admin and administration, you will see if you time that by 2, there's 34. It sort of reaches the same level of 2020. And because we probably expect their customers gonna pay more, or their revenue by the end of the year is definitely going to be over 2020. Therefore, their gross margin rate is actually going to go up. So this company, especially next quarter, or this coming quarter, their earning report is going to be very great too. Okay, and sales and marketing, we probably expect it to go up a little bit. If you times that by 2, they're basically tuning down their marketing channel because they think, we're at the growth stage and we already reached out most of our lighthouse customers. They're literally just reeling in all their profit on 2022 and 2023 all the way until 2024. Why? Because if you guys have any friends who works for the big four accounting firms or work for any big corporations, and if you have a friend that go on business trips very often, and you have friends that will go on flying trips, overseas trips a lot, who basically accompany their clients a lot, you will see that there are a lot of bills to be taken care of. And these are very tedious process if you're trying to do it manually. This is where Expensify actually come in. It's so simple. You have a receipt, you take your phone out, take a picture of that, and then you literally scan the stuff, and then the app itself will categorize all of them to you. And I think at one of those days, they're gonna pivot toward a tax reporting app, which is gonna be so great too. But anyways, all of these expenses are going to decrease over time, and therefore their revenue, the gross margin is going to increase. And what else on the sheet is really important? You see a drastic increase of net revenue, right? Net income, I mean, this net income is also adjusted for all expenses, all those kind of stuff. And I think income taxes also, but they offset a lot of income taxes due to previous years accounting things. They all have really good accountants. You probably will expect income taxes to go up, but their general trend of net income is going to go up also over time. Therefore, right now the market cap value is actually not overvalued at the moment. And what you really need to know is actually this number. You see, income per share, net income attributed to common shareholders. Okay, you have net income of 14 million, right? 5.2 million is attributed to common shareholders. So if you do the math, you'll see that this number actually tells you that right now the maximum public controlled flow is only 36%. That means the IPO price, that means the IPO itself, the stock itself on the open market only represented 36% of I don't know how to explain this in a straightforward way. That just means the lesser common flow that the company is giving out, the more valuable and the more scarce this IPO is gonna be. And then when the accumulating participating security holders, like participating preferred holders, like the VCs, the PE people, the banks, when they start selling, then the stock will sort of significantly go down a little bit to an equilibrium point. But they haven't A, they're not allowed to sell yet because they have a lockup period of 180 days. And then B, I don't think they're gonna sell until they make about 5x to 8x return. And Expensify is one of those rarest unicorn stock you will ever see basically this year, or even next year, or in the next 5 years, or in the period of like from 2018 all the way until like 2023. Another thing we need to talk about is, right here. So right now we can actually figure out the total addressable market. So that means, technically speaking, the small and medium business is where they're targeting. It's about 12 billion market cap, right? And then if you calculate the global market cap, their total addressable market is somewhere around like $21.5 billion. I honestly think it's underestimated a little bit because everything's happening in 2020. So let's just say it's true. Let's just say it's $22 billion they can totally address, right? And then right now their market cap is $3.4 billion. So it's only 1/5 of the total addressable market. And because I'm so confident with the product they're providing, I think they can capture at least half of the market cap, which means their actual projected true value is somewhere around, let's see, it's 3 times its market cap by around 2024 to 2025. So right now, if we go and look at Expensify, right now it's at $47, and $47 is reflecting the market cap of 3.8 billion. So let's just say it's 4 billion. So we're saying that the market can reach 8 billion at no time, especially with current growth and everything. What does it mean? That means Expensify can be around $90. I do think in about 3 years it's gonna be $90. And maybe it will even FOMO up like next week or so, because really nobody really know how much money this company can make and how much potential this company actually have. And honestly, a lot of people are asking like, why did you pick Expensify but didn't pick Rivian? Because I honestly think Rivian is overvalued, and Rivian have a upper cap of a 46% increase. If you guys want to see a Rivian video, I can also make a Rivian video, because I've been analyzing their S1 since the EV hike started, and I honestly thought their IPO price is around $80, and the runner-up is about $130. But right now they started out at $100, and right now it's at $130. Because I'm so familiar with their fundamentals and I understand the competitiveness of the EV market, eventually there are so many major EV makers, and usually only 20% of them, or 20% of them will be successful. And if you look at the EV configuration or demographics of who's buying what, who will buy what, but depending on previous data, you will see we have clear winners and mediocre performers, but they'll still make money, and then clear losers. And for Rivian, Amazon invested in it, and I think Ford invested in it. What they see as a strategic investment. Anyways, I don't really want to get into too much of it. Every IPO I invested in, I always want to see an at least 100% return. In Expensify, we're almost there. We're honestly almost there. And I think this is it for this video for now. And let's just see how much it can run on Monday. It may or may not run. It might stabilize. If it stabilizes, it will drop down. I will probably trying to absorb more shares. So then later on, in about 10 or 15 trading days, I think options gonna be on the market to trade for Expensify. I'm not really sure how usually it works. Usually I think it takes 15 trading days. We already passed 3 trading days, so 12 more trading days. And hopefully the options can come out more or come out faster, so I will actually have a more comprehensive understanding of, in terms of yearly, in terms of weekly, in terms of leap options. I can start buying leap options to really minimize my risk, basically, because every time I hold physical share, I really want to sell cover calls. So then when I can sell cover calls, that means I can basically took some of my existing profit out without selling the stock. Anyways, hopefully you guys love this video. I love Expensify, and if you guys want me to cover Expensify as our weekly or daily ticker, I'm totally willing to do it. And I'm totally willing to talk about Fisker too, because I also love Fisker, if you ask number 2. For those of you who are late on this channel actually originally founded by 2 people. We have me, whose name is DD on the internet, and we have number 2, right? And number 2 haven't been on, actively on YouTube, but he's been doing a lot of groundwork and doing a lot of the thumbnails and everything. If you guys want him to be more on more videos, let us know, comment down below. But anyways, like, we have companies that we absolutely love, and all of the companies we absolutely love have at least a 20% runner-up this year, and most of them already have a 40% to 50% runner-up this entire year. Alright, see you guys on the upside. If you like those kind of content, smash the like button. And of course, if you haven't subbed, go sub already, guys. You know that after you sub in this channel, your stock portfolio is just gonna go up the and up the up. See you guys on the upside.